My name is Becky Lester. It's been a pleasure to have you here on campus at Stanford. I'm so glad that you've had a chance to enjoy our balmy California weather. Perfect month to come and visit California. Needless to say, thank you so much for traveling out here and being here. I'm delighted to be able to introduce the tax paper, one of the tax paper that's on the schedule today. So same format applies, and I'm going to introduce Paul Demeré, from the University of Georgia, who is going to be presenting his paper around public disclosure of tax return information. 20 minutes. Take it away, Paul.
Hello, everyone. Oh, that's a little strong there. Might have to bump that down. Hope you're all doing well today. As Becky said, my name is Paul Demeré. I'm at the University of Georgia. I do want to thank the RAST Conference organizers and the RAST editors for this incredible opportunity to present my research to y'all today. So I'm here to talk to you about whether tax return information is useful to equity investors. And this question that makes up my title is actually part of a much broader policy debate over whether corporate income tax returns should be publicly disclosed in whole or in part. While this debate has a long and interesting history, it's come to prominence again in recent years as a number of countries around the world are considering some pieces of corporate income tax disclosure in the near future. Now, I do want to caveat up front that there are a number of different facets to this debate, a number of costs and benefits to tax return disclosure, and there are some other studies that have examined some of these other costs and benefits. I'm going to focus on the usefulness to equity investors, in part because whenever this debate arises, one of the biggest, if not the biggest, point that's raised is the usefulness of tax return information to investors and other stakeholders. As we can see with this slightly smaller than I'd hoped quote by former IRS Commissioner Mark Everson, who's advocating for disclosure, he suggests there's a lot of information in tax returns that could benefit stakeholders, such as providing a powerful tool to analysts and helping others better evaluate counterparties and risk. Of course, this is also a debate, and so you got counterpoints from disclosure opponents like former SEC Chairman Harvey Pitt, who suggests that all the material information you find in tax returns is already there in financial statements. We don't really need to provide tax returns to investors. So that kind of sets up this discussion of what kind of benefits you might find and the counterpoints to these arguments. Proponents of disclosure would argue that there's a lot of detailed information in the hundreds and often thousands of pages of corporate tax returns that you're not going to get from other corporate disclosures. It may be that some of this information is going to be useful to investors and other stakeholders. But disclosure opponents argue that we have rich disclosures around taxes already in financial statements. And a lot of the material information that's needed is already there. So you're not likely to find material information elsewhere in the tax return. Another possible benefit here of corporate tax return disclosure is the income tax accounting itself. See, income tax accounting measures firm performance using a different measurement perspective than GAAP. And so it's possible, to the extent there's noise in both metrics, that income tax accounting metrics and GAAP metrics being provided together to investors could help investors find the sources of noise in both, understand the amount of noise in both, and therefore get a better picture of firm performance with both measurement perspectives available. Of course, the danger here is that while GAAP is designed for the informational needs of financial statement users, tax accounting isn't. Tax accounting is designed to raise revenue for the government. It contains a lot of corporate subsidies that are going to add noise, perhaps so much noise that you're not going to get any value out of this alternative measurement perspective. Finally, proponents of disclosure argue that, well, yes, there is a lot of tax information in financial statements. To understand a company's tax positions explicitly requires sometimes a lot of detailed digging and complex calculations to kind of piece things together. If you could just give investors the information they need in a salient manner, such as giving them the corporate income tax return, could improve investor processing of tax information. Of course, the Tax Executives Institute has pointed out that given the length and complexity of tax returns, It may be that they're going to be misinterpreted and misweighted by investors, which could significantly harm investor valuations. Now, there is some related tax literature that's also worth mentioning here. There's a number of accounting studies that show that tax information in financial statements has unique information about a number of firm outcomes, incremental to pre-tax income and other pre-tax items, perhaps due to its link to the tax return and income tax accounting. But I'd point out a couple things here. First of all, that information is already in financial statements. And second of all, there's also a number of studies that show that these informative financial statement tax metrics are misunderstood by investors and other stakeholders. Now, that has led some in this research to call for disclosure of public disclosure of corporate tax returns under the idea that it might improve investor processing of tax information. But if investors can't understand the information that's designed for their use in financial statements, are they going to get anything from tax returns which are not designed for informational content? I think it's really unclear. I think there's a lot of good tension around this question of whether tax return information is useful to equity investors. So hopefully I got you all on board. This is an interesting, intense question. The hard part now is how am I going to examine it? And it's hard because tax return information is rarely observable. And when it is, you'll get little bits in these public disclosure events that are often confounded by a number of things. For example, a few years back, Australia began publicly disclosing a couple line items from large corporations' returns. While there were significant investor reactions to this disclosure, it seems that much of the reaction was not due to new information. Indeed, investors appeared to have been able to predict this information ahead of time, but rather because when this became public, the generally less sophisticated general public got a hold of it. And there were consumer boycotts, there were calls for changes to tax law, there were calls for greater tax enforcement, all of which could significantly harm companies. So trying to piece out the information content here is difficult. And so ideally, what you'd like is a setting where there's some information given to investors, but maybe much less likely other parties that are going to have strong reactions here. And I might have found such a setting within US syndicated loan markets, okay? So in case you're not familiar with syndicated loan markets, although we just saw a paper about this, you've got a borrower who's jointly borrowing from multiple lenders. These are oftentimes banks, but they may include institutional lenders, these non-traditional lenders like hedge funds, mutual funds, insurance companies. Now, there's a lot of research that shows that when you borrow from lenders, you got to provide them with a lot of private information. There's a lot of different types of private information here. Of interest to me is a couple studies that have shown that tax returns are a major request item by lenders when you're lending money out to borrowers. Now, I would acknowledge these studies are among small businesses, so they may not hold in the public companies that I examine in my study. So I went out and I read through 1,800 loan agreements, and I found that among these loan agreements, about 45% either required the provision of some tax return information or indicated that it had already been provided as part of the due diligence process. I also found that almost 99% of loan agreements allowed borrowers to request any additional information they wanted and get it either through an information request or by directly inspecting the borrower's books. So it seems like in many cases, tax return information is provided, and in almost all cases, lenders could probably access tax return information if they wanted it. So I believe the tax return information is likely provided to lenders as part of the lending process. Then there's a lot of research that also shows that when lenders get private information, it tends to leak to outside parties. Particular interest to me is research that shows that it'll leak to equity markets, but not in every case. Only when you've got these institutional lenders in the syndicate or the syndicate set up to target these institutional lenders. So if tax return information is provided to lenders and leaks to equity markets in certain types of syndicates, that might set up a traditional difference in difference design, where I can look before versus after syndicated loan issuance. And I can look between syndicated loans that are targeted towards institutional lenders versus those that are not. And I would expect in the bottom right corner here that that's when tax return information might get transmitted to equity markets. And if it does, then I should see two things. First, I should see a change in the fundamental association between tax expense and returns, as new tax-related information is being impounded into returns. Second, I should see a reduction in some of these previous tax-related market anomalies, where after tax return information is passed along, there's a better understanding of the information content in tax disclosures more generally. Yeah. Now, I do make sure that all observations in my sample are within a 6-year window of loan issuance, and every loan is a syndicated loan here. I include a number of controls, including a battery of risk controls and the cash flow variables from HEPFR's forthcoming accounting review paper. And I'll entropy balance across treatment and control firms to control for covariate imbalance and address some selection bias potential. And what I'll find is this. So first, when looking at tax expense valuation, I want to highlight something from prior research. Prior research does typically find that tax expense is positively valued, which may seem unintuitive, but tax expense is a linear transformation of taxable income. Taxable income is a measure of firm performance, and so prior research shows that tax expense has this proxy for profitability role. And so looking at what I find in this kind of difference in difference design, I generally find a significant or insignificant positive valuation, except in the pre-loan period for these institutionally targeted loans, where they don't seem to be picking up this performance-related information. Then after loan issuance, they do. And this is difference in difference coefficient here in the bottom right corner, statistically significant. It seems to me that this may indicate, with the change in valuation, that tax return information, when it's transmitted, is useful to equity investors, is being included in their valuations, and is helping them better understand firm performance, given the sign on the change there. So I'll also look within a subset of firms with high discretionary accruals. Prior research shows it's typically where the proxy for profitability role is strongest, and I do find stronger results. I also control for firm fixed effects, continue to find results here. Then moving on to tax anomaly returns. Looking first at the tax expense surprise metric from Thomas and Zhang, I find evidence of significant tax-related mispricing in the pre-loan period for these institutionally targeted loans. After the loan is issued, when I expect tax return information to be transferred, these anomaly returns go away. Statistically significant difference in difference coefficient here, which suggests that tax return information is helping investors more efficiently value tax information. And it's pretty economically significant as well, to the tune of about 10.2% reduction in anomaly returns. Seems perhaps large, but Adum and Murfin show that the total information advantage of lenders here is equivalent to about abnormal returns of 30% annualized. So that's small relative to 30%, but it is still a substantial portion of that, which may indicate that tax returns are a major source of the private information edge that lenders have. I'll then look at the tax income to book income metric of Levinism. I find similar results, but they are only statistically significant one-tailed, so not as strong there. I then look at some cross-sectional results. I do find some evidence that my results are stronger when information likely flows to lenders faster, as you would expect, when financial statement tax disclosures are likely to be more opaque, and when tax return information is likely to be more valuable, especially after Schedule M3 was implemented back in 2005. But I do want to also caveat here, if you've read the paper, you notice there were a lot of insignificant results here. That may be because this is a quadruple interaction here, and so the VIFs are extremely high here. I then do a number of robustness tests. I test for violations of parallel trends. I find parallel trends assumption holds here. I do a number of placebo tests to try and see whether I find similar results with other expense categories. Non-tax anomaly variables, I don't. I even try and induce a risk bias by treating only the riskiest loans or pseudo loans in this case as treatment firms, and I don't find any results. I also include a number of alternative controls, use stacked regression designs, control for fixed effects, continue to find results here. Now, in wrapping up, I do want to acknowledge a couple things in case you haven't noticed from the presentation already. I don't see tax return information. I don't observe it. I don't observe the transmission to equity investors, and I want to be open and upfront about that. There are advantages to this indirect approach because I can avoid some of the confounds you get in a public disclosure event, but it does mean that there's potential that my results could be affected by selection bias, omitted variable bias, or the transmission of non-tax return information. A lot of the robustness tests I did were designed to address these in some way, but no test is perfect, as we all know. My inferences also rely on the assumption that lenders do actually obtain tax return information and use it, even though it may be stale relative to financial statement disclosures. So I do want to acknowledge paper is not perfect, but I've tried to work hard to get it as robust as it can, given that this is a very hard question to examine. All right, thank you. In conclusion then, I'm hoping that this paper can shed some indirect evidence on whether tax return information is useful to equity investors and provide some much needed empirical guidance to this debate over public tax return disclosure on one of its key sticking points. Also hoping to contribute back to tax accounting literature here by showing that tax information, not just from the financial statements, is incrementally valuable to non-tax information, but tax information from tax returns is incrementally valuable to financial statement information. And by giving back a little bit to this research on loan syndicates, by showing that tax return information appears to be a major source of the private information advantage that lenders have here. So with that, I would like to thank you all very much for your time. And I look forward to your feedback and from hearing from Stephanie here. Thank you.
Good morning, everyone. I would like to thank the RAST editors for asking me to discuss this paper. Thank Paul for writing it. I found it very interesting. I hope my comments are helpful to him. And thanks Stanford for hosting this wonderful conference. So the title of his paper gives you the research question, and I think Paul did a really nice job explaining it. He's interested in whether or not tax return information is valuable to equity investors in their valuation of firms. I won't spend too much time on this either because I feel like Paul motivated this paper very well. But this is a really important question in the tax literature, and I think broadly even in valuation. So can tax return information help equity investors? There's been a long debate about whether or not tax return information should be disclosed, and it's not just about valuation. The pros are that it could help increase compliance, right? If you have to disclose how much you are, you might be shamed into paying more because you're a bad corporate citizen. It could also help to reveal tax risk to investors, which is something that we've found investors to be more and more interested in knowing about as we see more firms avoiding taxes. And then the last one is just that, like Paul explained, taxable income is measured differently than GAAP income. So there could be information that's incremental to the GAAP income about future profitability and useful to investors. Now, on the flip side, there are many people who are opposed to the disclosure of tax information. One of the biggest things is, proprietary costs. Firms don't want this to be disclosed. They don't want their competitors to know about what they're doing. They spend a lot of money to tax plan. And we saw even when FIN 48 started, which is just a disclosure in the financial statements, that investors actually preferred vague and opaque disclosures because of the fact that they don't want their competitors to know what they're doing. And then, as Paul mentioned, Marlene has a paper, Dave Weber has a paper. Analysts they can't really even understand sometimes the tax information that's in the financial statements. So do we really think they're going to be able to understand the information that's in the tax return? So it may not actually be helpful for decision making if they can't process it correctly. Okay, so there's a lot of different sides to this debate, but it's a very important question. And I really applaud Paul for finding a setting where he can try to get at it, because there aren't very many where we see that the tax return information is actually disclosed. Okay, so he is looking at this syndicated loan market. So he knows from prior literature that these lenders to small and medium-sized businesses do request tax return information, and he confirms, as he explained in a sample, that they're requesting it even for these larger borrowers. And there's been tremendous growth in the use of institutional investors in these syndicated loan. So it has gone up to about like over 70% of these syndicated loans use institutional investors. Okay, and we also know from prior literature that they're somewhat misusing the private information. So most of the papers about institutional investors, and they find that they're sharing the information that they get as a lender with their equity arm. Okay, so that's he's relying on here, that they're getting the tax information as a lender. It's private information, but we've seen through prior studies that there's leakage. And so if tax return information is one of the things they're getting, and if this is getting leaked, then we should be able to see how it affects their investment decisions and their valuation. Okay, so he is predicting that if tax return information is useful to investors in their valuation of firms, then we should see a change in how tax expense is valued from before to after the loan issuance, but only for the loans that have institutional lenders. Okay, and as he explained, so he doesn't have, he doesn't actually see, which ones have institutional lenders, but he follows prior literature, and any of them that are rated B or above, he classifies as an institutional investor loan. And then he does this difference in difference design, comparing the change in the valuation of tax expense from before to after, and then between those that have institutional investors as lenders and those that do not. Okay, so just a quick summary of his results. This is for the valuation of tax expense. As you can see in the pre-loan issuance, the institutional loans have a negative coefficient. So basically tax expense is valued negatively. As Paul explained, the profit for profitability role of tax expense would say that because tax expense has information in it that's incremental to GAAP income about future profitability, it should have a positive coefficient. But looking back in prior literature, the results are mixed on how tax expense is valued. There's also what's called a matching role. I mean, inherently tax expense is an expense, right? So it could represent value lost in the current period and future period for cash taxes. So Light finds results consistent with the matching role. Hanlon, LaPlante, and Shevlin find results consistent with proxy for profitability. And then Thomas and Zhang look at both of them and say, they both could be there, right? If you're not controlling for future profitability, then the matching role will manifest. Or if non-tax variables are very correlated with future profitability, that also could dominate its role as being a proxy for profitability, okay? So he kind of finds both. In the pre-period, he's finding that the institutional loans, it loads more like the matching role. But then in the post-period, it has a positive coefficient, so it's serving more for the proxy for profitability role. And he finds that in the pre-loan period, The way that the tax expense for the institutional loans is valued is significantly different than how it's valued for those that are going to get non-institutional loans. And between looking from pre to post, there's only a difference in valuation for those that are institutional loans, not for the non-institutional loans. Okay, so this does seem to support his prediction that having the tax return information, if only the institutional loans get it, that it does change their valuation of tax expense. And then for the anomaly test, he finds that the tax anomaly only is present in the pre-period and only for the institutional loans. So if they're getting this tax return information, when they get the loan, it helps to drive this anomaly away. Okay, so now for my comments. First, I want to talk about the dissemination of tax return information by institutional investors. Okay, so Paul basically predicts that the tax return information is only being disseminated to the equity side via the institutional investors. Okay, but Chin and Martin have a paper where they look at bank-affiliated analysts and find that after the bank gets a loan, and presumably this private information, that their forecasts become more accurate. Now, we probably all believe that there's this Chinese wall at these banks, but the evidence in that paper suggests that even at the banks, some of this private information is flowing outside of just the lending arm. Okay, so I don't think this needs to change much of what Paul is doing. It's just more, his prediction is that, only the institutional loans get this information, but the evidence in the prior study suggests that even at the banks, it might be flowing. So I think just restating it as, you would expect the result to be stronger for the institutional loans, which is what he finds, is fine, but just an acknowledgement that it is flowing even on the bank side as well. The second comment is because there's been a lot of attention paid to the fact that the private information is flowing outside of the lending arm, mostly at the institutional investors, but possibly even at the banks. There's been a lot of backlash against these institutional investors for doing that. And so, they're kind of faced with two options. Either they invest a lot in building the infrastructure to have a Chinese wall, or they basically say, you know what, we're not going to take the private information. We're just going to be public. Just give us the public information because we don't want people to be thinking that we're trading on this private information that we're getting as lenders. So Regina actually has a new working paper with co-authors that they look at this, and they're called public side lenders. And the use of public side lenders has grown a lot. So, it was 6% of their sample in 2004 to over 50% in 2017. Okay, so this is something, and the vast majority of these public side lenders are either institutional investors, foreign banks, or small banks. And it's because for these entities, building that Chinese wall is really expensive. So it's just easier for them just to say, we're just not going to take the private information, only give us the public information. So I think that because the growth of these public side lenders overlaps with the sample period, I think Paul's going to need to figure out some way to figure out which of the loans have these. It might require looking through all of them because it does state it in the loan contract that the lenders are not going to accept material private information. And the borrower will even separate what they're considering to be their public information and what's their private information. So I don't know if it's going to require doing that, but Regina's here. So I would suggest maybe talking to her at the break and trying to figure out maybe if there's an easier way to kind of proxy for which loan agreements actually have this. Because if a lot of the institutions are declining the private information, it's unclear how much tax return information they're getting to begin with. Okay, my next comment is that the loan issuance is a significant event. We would expect the firms to change quite a bit after they get these loans. They're not financially constrained as much anymore. The lenders are monitoring them. So for all of these reasons, they kind of become like a new firm. So that might explain why tax expense is valued differently after they get the loan. Now, Paul is really clever in how he designs this, though, because he says, well, you know, I'm looking at a control group that also gets a loan. So presumably they change also when they get their loan, but they don't get the tax return information. So if I find a difference in the valuation of tax expense only for the ones that are institutional, well, yeah, they changed, but the other ones changed too, but these only got the tax return information, so it must be attributable to the tax return information. And that seems fine, but the only thing is that the firms that are receiving the institutional loans are significantly different than the ones that don't. I mean, they're the ones that are getting the loans ranked B or higher. They're much riskier than the ones that get non-institutional loans. And we see that in the descriptive statistics. So they have a significantly higher frequency of default, and they have a much lower Altman C score. So these are riskier firms to begin with. And so even if all of them get tax return information, let's say the institutional loans and the non-institutional loans get it, just the fact that the ones that are institutional are riskier might mean that the change in the valuation of tax expense or how investors respond to the loan issuance could be different. The results in the 2x2 that I put up don't have controls for risk. Paul does present results with a lot of control variables. And when you calculate the change in the tax expense, the valuation of tax expense there, it's much smaller. I can't figure out if it's statistically significant. And I understand why he wants to focus on the specifications without the controls, because that's generally how we value it. But more needs to be done to kind of take into account the fact that these firms are much riskier and the change that could be occurring for them when they get the loan issuance. It could be a much bigger deal for them than for the non-institutional loans. So this also leads into my next comment, which is related. It's an alternative explanation for the results. So prior literature finds that firms that are financially constrained, which I would argue that the ones that are getting the institutional loans are significantly more financially constrained than the non-institutional loans because they're riskier. But that financially constrained firms engage in more tax avoidance. Okay, I mean, the argument is, these firms need cash, and so they avoid taxes more in order to generate internal cash. And consistent with that, if you look at the descriptive statistics, the firms that get the institutional loans have significantly lower cash ETRs. Okay, so they do seem to be avoiding more tax. So when we think back to the 2x2 that we showed with the results of the valuation of tax expense, I explained that in the pre-period for the institutional loans, the coefficient is negative, and that's consistent with the matching role that tax expense can play. That basically it's an expense, and it represents a value lost in the current period and the future period. Well, in the pre-period, before these firms get those loans, they're very financially constrained. They care a lot about any additional cash that's going out the door. So the fact of a higher tax expense would be bad news, okay, which is why we're seeing the matching role in the pre-period. Lower tax expense would be good news. Once they get the loan, though, some of these constraints are eased. And so at that point, the proxy for profitability role is able to play a more important part in the valuation of tax expense. This could also explain why we only see a significant difference in the valuation of tax expense between the institutional and the non-institutional loans in the pre-period. Okay, so it's just another way of viewing the results, but it is kind of consistent with what we know from prior literature about how these financially constrained firms operate when it comes to taxes. So this would also explain some of the results in the tests that Paul has looking at the determinants of whether or not a loan is an institutional loan. So he basically is saying, you know, maybe these institutional lenders, when they see this, you know, tax anomaly for the firms that are going to get institutional loans is present in the pre-period, that they seek out to be lenders for these types of firms, knowing that they'll get the tax return information as a lender, and that then they can share that with their equity side in order to make profits on the equity side. So I think that, you know, it's potentially that it's just that these firms are financially constrained, right? And then they are avoiding more taxes as a result, and that their tax outcomes are riskier because of that, and that is just why, you know, the association between the institutional investors, which generally only get those types of loans, and then the firms that are the makeup for those types of loans. So I'm not sure if the institutional investors are really seeking these out in order to get the information. But it's possible, though. It's just not clear. And then my last comment is really just more about framing the prediction, and the writing doesn't really change anything that Paul has done. But, you know, the question is whether or not tax return information is valuable to investors. So if it's valuable, then it should change the way that they value the firm, value the tax expense. And we see that that happens. So I'm just more interested, and it wasn't quite clear to me in the writing. Are we just interested in whether or not having the tax return information changes the valuation, which we see that it does? Or are we interested in whether or not having the tax return information helps tax expense play that proxy for profitability role? So that's what wasn't quite clear to me, but that's an easy thing to just kind of address in the writing. So just kind of to summarize, you know, the question of whether or not tax return information is valuable to investors, I think it is an extremely important question. And I applaud Paul for being creative in finding a setting to actually address the question, because like he explained, there aren't very many settings where there is tax return information. I think more needs to be done to address the fact that some of the banks could also be disseminating the information, but more importantly, whether or not some of the institutional loans in his sample have institutions that are denying the use of public information. That to me is more key. And then finally, you know, he has done some tests to address the fact that the institutional loans are riskier, but I think that more needs to be done there just to make sure that that's not what's actually driving the results. But I really enjoyed the paper, and I wish you the best of luck. Okay.
Super. Okay. Paul, would you like to?
Absolutely.
Okay, let's start with the Ed. We'll do Ed, and then I'll go ahead and call the next couple people. So if you can keep your hand up. So Ann and Rakina and Andy, and then I'll take some more in the next tranche.
Hi, Paul at DeHaan, University of Washington. Really interesting paper. I'm struggling a little bit to think through exactly what the theory is and how that maps into this flipping sign result that Stephanie had. So if I understand your theory correctly, the tax return comes out, there's a whole bunch of signals in there. Now you still don't observe those signals, you don't know if they're using them, but what you can see is the tax response coefficient. So presumably they're using these signals to help interpret the existing tax expense information, right? So that's sort of like, they're now putting more weight on this signal, and sort of a whole thousand Berechia, they do it in the ERC, but the same thing. So if that's the case, it's hard for me to see how that sign flips, because in the pre-period, they still have the tax expense. They should be able to come up with an unbiased point estimate of the value implications of that number, but they don't weight it very heavily because the precision of their valuation is low. In the post-period, they have more information, it helps them contextualize it. What we could see is a bigger coefficient, but in that theoretical framework, I don't see how it flips the sign.
So part of the problem is that this theory here in this tax literature is a little tough, but we've really got two pieces of information bundled into one. where we've got this information about expense, this matching rule that Stephanie discussed, and the proxy for profitability rule. And so what you'd see is a coefficient flip if, say, you hold constant the matching information, but it's much larger than your proxy for profitability information. Now, all of a sudden, I get more information that's going to allow me to see the proxy for profitability rule, holding the matching rule constant. Just a simple increase in the weight on the coefficient of the positive information could see signs flip. And so I need to maybe explain that out a little bit more. I used to have a 4-page appendix that kind of walked through all this, but it got cut for time. So
yeah, I think that would be helpful.
Yeah.
Maybe for those of us not super familiar with the tax literature,
yeah,
just to spell out that theory quite clearly, because I think there is a lot of it in the ERC literature that
yes,
maybe is missing from here. That could help.
I loved that appendix, and so I'm going to bring it back, I think. Thank you.
Great. Regina.
Yeah, I'm of course biased because it's very nice to see the paper that reconfirms Bushman et al. 2010. But I have only 2 small suggestions that I hope can improve the paper. So you presume that participants get tax return information. It's very sensitive information, so it may be good to get some institutional evidence that they indeed get it, because the fact that Lead Arranger has tax returns doesn't mean it gets to institutional investors, because some information that Lead Arrangers get, if it's sensitive, stays only with the Lead Arranger. So if you can talk to a few Lead Arrangers or to some practitioners and make sure it gets through to participants, it will be helpful. And another small point is that I know you follow our definition of institutional investors, but literature has moved forward since our paper. And there are 2 papers, at least I can refer you, that do a better job than us in identifying institutional investors. So Limit All, I think it's 2014 or 15 at JFE.
Yep.
And Leila Piervan's dissertation at TAR. They also involve some other information, some information from DealScan, some information about industry classifications, and some information on hedge funds to more specifically identify institutional investors. So you can maybe by improving identification of institutional investors, you can get even stronger results.
Yeah, no, I appreciate that. I'll definitely consider the definition of those institutional investors there. And to your first point, I think I'll have to think about it a little bit more, but thank you very much. Yeah, yeah. Well, I'll say, so I've tried really hard. I've cold called cold DM'd a number of LinkedIn folks. I've even went out and I hired a survey company that's designed to, one of their key business models is finding rare survey participants. So I hired them to find folks who would be able to do this, and they came back to me and said, well, we can't do this, we'll just return your deposit. And I said, well, hold on. What if you can give me just enough for like an interview survey? And they said, no, here's your deposit.
Maybe LSTA will be another option. Loan Syndication
No.
Training Association may be another option, just informally
Yeah.
asking them what do they know. They're really helpful with academic research, surprisingly.
Yeah, no, I appreciate that. I will reach out to them. I will say, actually, I did manage to speak to one person who was at involved with the kind of managing the Chinese walls within one of the major lenders in DealScan, and they said that in every case, the tax return information or tax returns for multiple years were there for all syndicate participants. And so I do have one anecdotal data point, but I'll seek out more through the LTSA. Thank you.
Andy?
Andy Call, Arizona State. Nice paper and obviously important topic. When I was reading the paper, I was wondering to myself, if you were asking a different research question, which is whether institutional lenders make use of tax information that's provided on the face of the financial statements, as opposed to tax return information, what would be different if you were designing that study, what would be different in the setting or even the tests to answer that question? And ultimately what I'm getting at is your ability to separate your conclusion that they are using tax return information from a different possible conclusion that this is evidence that they're using, financial statement information about taxes. So I'm just interested in your perspective on that. And I guess as a related comment that was in my mind as I was reading some of your conclusions on the policy implications, there are very clear policy relevance here. And the vibe in the paper is that this would lead someone to encourage more disclosure of tax return information. Could someone also read your study and take your conclusions and your results at face value and say, well, maybe this is evidence that we don't need to mandate disclosure of tax return information because investors are already gleaning information that's relevant to taxes from the financial statements. So that's all kind of in that same soup of issues. I'm just curious in your perspective.
Yes, I appreciate that. As I've faced challenges with this paper, I've considered that alternative framing, kind of losing the tax return piece and just saying, hey, this shows how important tax information is to this special subset of like institutional lenders. I really think that tax returns are a powerful tool here, and I really want to keep that policy kind of point. And so I think you lose some of the coolness factor of the paper, but I think it would have saved me maybe some struggles along the way. And so it's something I have thought long and hard about. As far as the, could you take this like the other way? I would really strongly hesitate to say that because the information's there, it's not being used before the loan. So something about the loan setting for these loans that we likely see leakage of information to equity markets is changing valuation here. And so I'd say at a minimum, it's something they're getting, like tax return information is at least helping bring forward the information they already have. So it means something slightly different. It's not like they're getting new information, they're just better using the information they already have, but still that's usefulness for tax return information. So thank you. Yes.
Great. We're gonna take one question from online, and I want to get a couple of questions from the side. I know that you have a question here too. So the question is coming from John Robinson at Texas A&M,
Yep.
And the broad question is just about if you expect variation based on the type of institutional investor. And some more context around it is that he's commenting that according to the Fed, hedge funds prioritize investments in high risk spread loans, whereas mutual funds are typically spread across different types of loans. So would you expect that your results would depend on really the type of institutional investor?
Hi, John. So I'll be honest, I don't think so. And I think that kind of hearing this discussion, I may need to be doing a little bit of reframing around one of the key constructs in my paper. I'm interested in the institutional loans, not because necessarily there's institutional lenders there, but because these loans that are designed as like term B, term C, often are traded on secondary loan markets. And when you have the ability to trade on secondary loan markets, insider trading is legal. Because you can illegally, so to speak, trade in equity markets by legally insider trading within secondary loan markets. And then as long as your equity side knows that there's this insider information, which legally you can insider trade in secondary loan markets, that there's this information there, then they can mimic price movements in secondary loan markets, which incorporates this information into equity prices. And so I'm more interested in the secondary loan market trading than any particular institutional type, because that offers a legal pathway for information transmission to equity markets rather than relying on insider trading, although there are some nice anecdotes about that, or say movement through analysts.
Great. Okay, if you have a question, can you raise your hand? We'll maybe have just a couple more to go here. So we'll go here, Suong, and then anyone else have a question? Richard, okay, and then we'll do Richard afterwards.
Hi, first I want to say I have huge appreciation for tax research, maybe in part because I've been in the shadow of Terry Shevlin for so many years, my dear friend that I just left. So your research question reminds me of what seems to me an analogous question about the value of providing the cash flow statement. And by providing, so from a very narrow angle that I am aware of, it can help investors price their accruals more efficiently. And this is related to my RAST paper. And so I am wondering whether they are tax returns, whether having the tax returns, it's not so much to help investors understand all the nuances of tax, but actually to help the equity investors price the tax accruals more efficiently. And so maybe what you're estimating as tax expense may be coming from different tax accruals. And so sometimes pre-acquisition or pre-incorporation, it is negative sign, but some of the tax accruals post incorporation might actually be a positive sign. And so it's actually a question that I'm eager to get an answer from the tax accountants, whether one can think of the tax return as actually providing better tax accrual information to equity investors. And then on the second point related to that, it might also help citizens, not just investors, be able to calculate the returns to tax subsidies to corporations. And so then it's not so much that the SEC doesn't want to have it be out there, but the political world is against publishing it for political reasons.
So,
And then one last question,
No.
being an
Yeah.
anomaly president.
Can we pause there, just 'cause I want to make sure we get the last couple questions in.
all right. So since it seems we're running a little, I'll just say briefly, so to your second point, yes, there are a lot of potential benefits to tax return disclosure, one of which could be providing more information about the return on some of these corporate subsidies. And that's one of the things that's brought up. And I actually had a slide I didn't show that had all these things listed, including that as a possible benefit. And, or if your corporation is misusing subsidies, a possible cost, I suppose. Can the tax return provide information about tax accruals? I think that in theory, it could, if you don't have a good sense of, just thinking about like a valuation allowance. There, you may not understand what a company is basing their valuation choice on, but if you could get past couple of years worth of tax returns and see a little bit more clearly some of the trends on the tax return, you might get a better picture of how accurate the valuation allowance is. So I think it's entirely possible. Yes.
Thanks. Richard Sloan, USC. Yeah, your research design, if I understand it, it focuses on the contemporaneous ERC. The research design that would have jumped out at me is the future ERC, where looking at where the current stock returns better anticipate future profitability in the environment where they're getting this additional tax information. Mm-hmm. And I wondered whether you looked at that.
I have not. That's interesting. I'm willing to do that. Thank you. Yeah, so I have looked at whether or not profitability itself changes. I don't find any significant difference, but I'm going to check that other ERC. Thank you. I do, yes. Yep.
ERC-like thing, equivalent? Because
yes.
You're no longer seeing that predictability between today's accounting number and tomorrow's.
I think they're complementary because I think you could have an efficient market and you could still have the new information. Yeah.
Yeah.
So.
I think I will do them both ways, and maybe we'll see how they both look. So thank you very much. I appreciate it.
I would actually love to hear the debate between Charles and Richard, or the discussion between Charles. I would stay extra just for that, but I know other people might need some coffee and talking about the role of tax in that. So thank you so much, Paul. We have a 10-minute break now. Please come back.